ETF Spotlight. Mike Santoli's taking a look at this drop in energy during this market volatility, and I think incorporating some utilities in there too.
Yeah, I mean, essentially everything in the market right now is a yield story. It's a rate story. It's what yields are saying at these levels about global growth and commodities and things like that. Take a look at utilities versus energy, because it shows you the divergent effects this is having. Energy, I mean, clearly dealing with oversupply. OPEC seems behind and all the rest of it. But until you have the conditions under which yields would start to rise again, you're not going to have value stocks work. You're probably not going to have global cyclicals work. You're not going to have even consumer stocks to a degree. So I do think commodity stocks is where you're seeing that. Now, utilities, the world is hunting right now for stable yield. They've looked expensive for a long time. Kind of doesn't matter right now. So to me, the market's being separated into yield victims and yield beneficiaries, and unclear how long that's going to last. Every chart you want to look at of bond prices looks like they've gone completely parabolic, and it's a momentum move and nothing more, and maybe getting to a crescendo, but it's looked that way for a while now.
I wanted to bring up the credit market because and it's related to the energy story.
Completely.
What are you seeing, and how big of a warning sign is it flashing?
It's a building warning sign, but it's not necessarily at an acute level just yet. It's really interesting because it reminds me of fourth quarter of 2018 in some ways, where really it was a stock market-led move, and then credit appetite started to wane, and you started to see some stress in the system.
So what does that mean? Does that mean it's not recessionary? Do credit markets always lead into recession, or was that just during the financial crisis when that was the cause of it?
They've tended to get worse before a recession. I do think right now it's starting to build. I mean, the stress is starting to build. The spreads look like they're precarious, but most of it is because Treasury yields are rushing lower by so much. It is not necessarily a buyer's rebellion of riskier corporate debt, but energy is a big chunk of the high yield pool, a smaller chunk of the stock market than it used to be. So I do think this is where we're looking, though, right now, because suddenly interrupted cash flows for companies is what knocks the credit markets for a loop. And so I see it all part of a similar story, which is, you know, the VIX at 40, Treasury yields at 2/3 of 1% at the 10-year, and credit spreads widening out. All are telling you that stress is building, but it's interesting that it mostly was led this time by the sharp drop in the stock market.
Right, as opposed to, the bond market and the credit markets overall were showing signs of strain in the summer of 2007.
Exactly.
I mean, the Bear Stearns hedge funds, then obviously it was
a year. It was over a year.
Over a year. We hit new highs later in
October of 2007.
Right.